Is the Tata AIA Param Raksha Life Maxima Plus plan your gateway to wealth creation and protection, or just another ULIP with lofty promises? Let us find out through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decisions to reach your financial goals in a more faster and smarter way. So before analyzing this policy, let us first understand a few basic details about it. So this policy comprises a life cover for protection and market link returns for wealth creation, along with the Tata AIA Vitality Wellness Program. So this policy is basically a combination of two individual and separate products named Tata AIA Smart Sampurna Raksha Supreme Plan, which is a non-participating unit-linked individual life insurance savings plan, and another policy is Tata AIA Vitality Protect Advance Plan, which is an individual non-linked non-participating health insurance. So we have already analyzed both these policies in separate. So if you want to watch the reviews of the separate policies, you can find the link in the description. So some of the key features of the policy are: a lump sum payout is provided to your family in the event of an untimely death of the policyholder. You get to earn rewards through the Tata AIA Vitality for maintaining a healthy lifestyle. You get to enjoy an upfront discount on the Vitality Protect Advance premium in the first policy here. You get to receive an additional sum assured in case of accidental death. Benefit payout is available if you suffer total and permanent disability due to an accident. So upon maturity, you receive the fund value along with the refund of this policy's premiums. So now, as we have a basic understanding about this policy, let us move on to the analysis part of the video, where we are going to conduct an IRR analysis based on the benefit illustration provided in the policy brochure to help us make a more informed decision. So for calculation purpose, let us assume that a 35-year-old male has opted for this plan with a sum assured of 1 crore, an annual premium of 1,08,401 rupees, which is a policy term of 50 years and a premium payment term of 15 years. So here we have assumed the future rate of return of at 4% per annum and at 8% per annum just to indicate the worst and best case scenarios, but these are not guaranteed returns. This is just to show you how this policy can perform in both extremes as projected in the policy brochure. So the actual fund value will depend on market performance and investment management. So here at an assumed 4% return, the projected fund value is 16.48 lakhs, translating to an IRR of just 0.03%. So which is essentially there is no value creation. So a regular savings account would have delivered better returns. So at 8% assumed returns, the fund value grows to 1.56 crores with an IRR of 5.35% as per the policy's maturity calculator. So while this might seem decent at first glance, it's still lower than what many debt instruments offer despite being a market-linked product. So in essence, the plan fails to meet the core objective of wealth accumulation. The relatively low returns undermine the potential of market-linked investments, increasing the risk of financial shortfall in the long run. So therefore, investing in this policy may hinder rather than helping in achieving your financial goals. So now, as we know that this policy is not getting us the desirable outcome that we need, let us now evaluate smarter alternatives that can generate significantly better outcomes by using the same annual premium in this alternative strategy, which is a comparative analysis. So we are going to assume the same annual premium of 1.08 lakhs, which could be split between insurance and investment, by opting for a pure term life insurance policy for life cover purpose with a sum assured of 1 crore for a 30-year term and a 15-year premium paying duration. So the annual cost comes to around 25,200 rupees. So this leaves us with 83,201 rupees available for investment, which is a crucial amount that, if invested wisely, can generate far superior returns. So you can choose the investment vehicle based on your risk appetite. So if you want a low risk option, which is a debt option, you can choose PPF, which is a public provident fund with a government backed fund. So investing the surplus in PPF over a 50-year period results in a maturity value of 2.48 crores, delivering an IRR of 6.46%. So, despite being a low risk debt instrument, PPF can outperform a market linked insurance plan in terms of returns. So, if you're considering a high risk option like equity, you can opt for ELSS mutual funds. So, basically, any equity mutual fund as well. So, investing in an equity linked savings scheme ELSS fund yields a corpus of 18.34 crores over 50 years. So, after accounting for the capital gains tax, the post tax corpus stands at 16.06 crores with a post tax IRR of 11.02%. So if you want to know how we have calculated the tax for equity mutual fund, you can see that we have presented a small tabular column in the screen for your reference, which you can pause and see. So why does this strategy wins? First of all, higher returns, which is alpha generation. Both debt and equity options outperform the Tata plan across all time frames. Second, liquidity advantage. Investments like PPF and ELSS offer better liquidity, while the insurance linked plan locks your funds in until the age of 75 or 85. So, combining insurance with investment through plans like Tata Policy compromises both returns and liquidity. So, what is the final verdict then? Is investing in the Tata AIA Param Raksha Life Maxima plan worth it or not? So, this is a bundle product offering life insurance, market linked investment, and a health component. However, in practice, none of these features offers compelling value to the investor. While premiums are paid for a limited period, the fund value becomes accessible only at age 75 or 85, making it irrelevant for most life goals. The life cover continues throughout the entire term, increasing the cost of the plan. So, even though in personal finance, life insurance is typically required only until retirement, not lifelong. So, despite the policy's long term, the returns are unimpressive, and the maturity benefit comes too late, often after key financial goals like children's education, home purchase, or retirement have already passed, and it also has a high agent commission. So, this plan suffers from low returns, poor liquidity, and misaligned coverage, making it an unsuitable choice for most investors. So, bundled products like this often fail to serve either purpose effectively. A better strategy is to separate insurance and investment. So you can opt for a pure term life insurance policy to provide affordable and adequate coverage for your family's protection. So you can invest the remaining premium amount in a diversified portfolio based on your risk profile, time horizon, and goals to achieve long-term wealth creation.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.